Good morning and welcome to Purpose Driven Finances, where our focus is helping you use your finances to achieve the purpose and plan for your life. And now here's the host of Purpose Driven Finances, Alan Molina with Serwus Capital Management.
Hey, good morning. This is Alan Molina, your host, Purpose Driven Finances, president of Serwus Capital Management. Hope you're having a great and glorious day. The heat seems to be back a little bit. But I tell you what, my grass is growing, and I know I talk about this every week. I'm trying to get my sons to come mow the grass for me. And but, you know, it's just one of those things. Sitting here with my co-host, Mary. How you doing, Mary?
I am great, Alan. We're in August.
It's in August.
Mm-hmm.
I can't believe it.
I know.
It's like fast and furious.
Time is flying.
I know this is boring and people don't want to hear it, but I was sitting there this morning. I have a regiment for when I get up.
Okay.
The process of what I do.
Mm-hmm.
I've realized that I really operate well in a process. So I'm building a outdoor garden for my wife that has a spiral in it, not for her to go up and drop her hair down, but a spiral that you put plants in.
Okay.
So about 4 or 5 feet tall.
Nice. That's
gonna be the last thing. But I have a process. It's like 60 pages long. But for my morning routine, I have a process, and I was sitting there. I heat my milk before I make my coffee. Everybody wants to know this.
Yeah.
Everybody.
That's a little quirk. Okay.
Okay,
yeah.
That way, when I put it in my coffee doesn't cool. It's warm.
Mm-hmm.
And it was like 6, 7, 8, and I was like, time just keeps on tripping into the future. It just keeps on going.
Mm-hmm.
Please don't cancel me because I sang horribly. Mary, you're a singer. You're a bell ringer.
Mm.
My wife is a singer.
Mm-hmm.
She plays the piano. You play anything else besides bells?
A little bit of piano, that's all.
That's good.
Yeah.
Yeah.
And singing.
I can't even do chopsticks on piano. But, folks, what we're doing is we're in a portfolio management series. And partly is I want to educate you about when you go talk to a financial advisor. I tell you, of course, I'm not going to mention their name, but I met with a new client this week. And he had some of the best questions that I've ever had from a client or new client or a prospective client.
Mm-hmm.
And Mary, it wasn't the kind of questions like, oh, are you a fiduciary? Because a lot of people, they get nervous when they want to move their money or go from a 401k to an IRA.
Yeah.
They get a little nervous. Like, I'm possibly turning over my entire nest egg to this financial advisor. I'm nervous. But he brought questions that he didn't go through Google. He just thought them through. And it was amazing, the depth and the breadth. But also one of the last questions that he asked me was, he says, Alan, I consider you a friend. And this is the second time we met. He says, Alan, is there any questions that I have not asked that are applicable? And which I thought was a great question.
Mm-hmm.
And I tried not to go deep into the weeds. But the reason for this series is to try to educate you to make sure the financial advisor that you have is the one that you want, the portfolio management style is what you want, and what makes common sense to you, and make sure that it meets how you are, how you're comfortable, things such as that.
Yeah.
So that's really so today we're talking about what are you watching?
What are you watching? So we were talking about our weekends,
right?
And you said you were going to be doing some gardening, helping your wife. I'm going to be hiking. I was going to swim, but now I'm going to hike.
See, I didn't ask you. You're so nice. I'm glad you told me.
No, but something I'm not going to do is be watching to see what's up with Bitcoin and AI and tariffs and earnings and the Fed. I'm not paying attention to all that stuff.
And that's the way most people are.
And it's not just, and to be honest, it's not just for the weekend. I'm usually never paying attention to that stuff. So I guess the question is, you're the one paying attention to that stuff. How does the average person know what actually matters when you are getting bombarded with all this stuff, but you don't have the time to be analyzing it every hour of the day?
Exactly. And that's my job, or it should be my job. Because what's been interesting is the last 2 new clients I've gotten, they're like, Alan, what time you get here? I'm like, well, this week I'm getting in here 8:30, and they're like, wow, that's pretty early. What time you leaving? Probably 5. wow, you're staying late. And what I get is a lot of times, like when I was at one of my former firms, Rich never likes me to mention them, but you're not Rich. Just look up, I've talked about who they are. And this is not throwing any shade, it's just who the financial advisors were. This one financial advisor, in production, he was probably medium range. His income per year was probably $150,000, $175,000. And when I say mid-range is of financial advisors, not in totality of income, because that's obviously much more than the average. But what he would do is he would come in at 10 and leave at 2 every day. That's a good stick if you can keep it up. That's a good. It's a good thing. But I'm on the opposite end. Like this past Saturday, I worked 7 hours at the office. Yesterday, I got home about 6. Not yesterday. I'm taping on Friday, so Thursday I got home at 6. And it's not because the world's falling apart. It's just because I enjoy what I do, and I'm always trying to make everything into a process. And so I agree with you, Mary, that most people don't follow Bitcoin, the Federal Reserve. The Federal Reserve, WARSH. I like that country term. He was out there and he was speaking. Very impressed with the guy. What about interest rates? What about, there was a hedge fund this week that blew up. I mean, it blew up. He sold to another hedge fund for, my guess, pennies on the dollar. But most people aren't professional investors or advisors, and they don't have to become one. They need to have a financial advisor. They need to have a portfolio manager, financial planning that actually does these things. And the thing that I have found is the issue is not too little information. It's too little filtering. And every headline wants attention, at least CNBC or Fox Business or Bloomberg News. They want attention. And sometimes I turn them on in order to get, like right after the Federal Reserve releases their notes, I'll turn them on to figure out what the institutions are saying. But not every headline deserves it, like SpaceX. I had a few clients who were like, Alan, I want some. Aren't my clients happy we didn't buy any? I mean, I think right now it's trading at 110. It hit 210 a couple weeks ago. Now you talk about a pain of hurt or a world of hurt. And really what I try to do is make everything into a disciplined process that helps separate information from the noise.
Okay.
And the key there is if you separate information from the noise, then you can actually have something that you can actually work through and do.
So what should you be considering before you react to a headline?
Well, a few things that you should be doing is when you hear something, oh, they didn't raise interest rates. The market's down 1,100 points. That was a brutal day on Thursday. Now Egypt is being attacked. You run the daily news on WLNI, at least I hear you often. I could probably ask you, Mary, what's going on with the water up in Minnesota, or 30 townhomes were affected? I don't really know. You know more about it than I do. But that really does it change, first of all, does it change your long-term plan? Does it change your plan for next week? Next week I am going out of town for a wedding, but it's also to test my ability to manage people's clients out of the office because I'm required to. When derecho hit, we were out of power for almost 2 weeks, so I had to go to Williamsburg. And so when you hear something on the news, does it affect your long-term? Does it change the risk in your portfolio? I'll give you an example. On yesterday, when I say yesterday, we're taping on Friday, so it's Thursday. The markets got beat like a rented mule. I mean, it was ugly. The Dow was down 1,100 points at one time. The NASDAQ was down almost 2%. I mean, it was ugly. So my question is, are you comfortable in that? Mary, again, this is a great question, not a great question, but a great illustration. Did you know that there's some investments across the entire, the investment world that are down 20 and 30 and 40%? Specifically in the chip market. And if you were to look up Taiwan or South Korea, not Taiwan, Taiwan and South Korea, those markets have been pummeled. At one time, 1 in 26 people in adult men were getting a margin call. That means they had to bring in money because their portfolios were down so much. Then does this require a decision, or is it simply today's headline? These are questions you need to ask yourself. Am I responding to evidence or reacting emotionally? If you are reacting emotionally to your portfolio, then some things need to change. And sometimes it has to change within you, but often it needs to change within the portfolio. And then finally, good judgment matters more than just information. Because when you're sitting there and you're inundated with information. Mary, did you know it's been studied over the past, and it's been let out in the past 2 months, the average adult time span that they keep their attention is 8 seconds now?
8? It's down from what? It was 30 and now it's 8.
Right.
So it's just getting shorter.
Yeah. And the reason being is all the reels.
Yeah.
I mean, doom scrolling, people call it doom scrolling.
Yes.
What's the difference between looking at your phone and looking at Friends or Kramer? We sat there for half an hour just watching TV. We didn't call it doom watching. So I think it's a negative thing. So realistically, that's really some of the questions you should be asking.
You love to share stories and analogies to make your point, and I know you have one, a driving analogy.
Yes,
and that helps explain this.
That's great. I appreciate that, Mary.
Yeah.
I am trying to make it to where, because one thing I've realized is I get into the weeds so easily because I am in this all the time. Like when my wife is answering texts and emails in the evening, I'm working on work for 2-3 hours, just hammering it away because I enjoy it. So imagine driving a car from Lynchburg to Florida. Okay. You're driving. Yeah. It's enjoyable. Hopefully you don't have little kids. Well, I hope you do have kids, but hopefully they're sleeping. Do not give them Benadryl. I never did that. I have a son here. He can attest. I never gave him Benadryl to make him sleep. But make sure they're fed, and I almost said watered, but they're not a plant. Now, as you're driving, down the road, do you just stare at the gas gauge? Do you stare at the mileage? Because what happens if you just stare at those things? What happens is you watch the road, you watch the traffic, the speed, the weather, the mirrors, construction. Mary, one time we were going down to Florida, and it was going to South Carolina, and we had a trailer getting furniture for our new house, and I was coming in hot. I didn't see the construction. We had to hit the brakes and go on the side. So you got to pay attention. And driving, but the different gauges, they matter. And that's why they have a bright light or a ding or whatever it is. And so driving safely is not about watching everything. It's about watching what's in front of you that matters. You're driving down the highway at 70 miles an hour and a deer is 50 feet away. Do you really need to be concerned about the deer? Probably not. Or if there's a wreck on the other side of the road, do you need to be concerned with that? Probably not. And that's the way with portfolio management. You need to watch. Watching only the stock market or the news causes you to really miss the purpose and plan for your money, and that's the long-term dreams and goals that you have.
So as long as we're continuing the analogy of what gauges are you watching, what gauges is a professional portfolio manager actually watching?
That is a great question. And what I have tried to do, and what we're going to talk about the second segment, is really talking about the various things that I look at, that many other folks look at, and then go into the environment of what and how you should react and act, but also some questions you should ask your financial advisor, and if you're happy and content with your current financial advisor. So, folks, I think we're going to a 30, 60-second break. I'm not really sure. I'm not in charge of those things. But stick around. Give me a call, 434-316-0246, or go to my website, servuscm.com. Catch you on the flip side.
Hi, everyone, Brian Kilmeade here. Coming up on the next edition of the Brian Kilmeade Show, we'll have the biggest newsmakers, news breakers, and take a deep dive into news you care about. Whether it's breaking news, entertainment, politics, or sports, even pop culture, I'll bring you the latest developments with expert analysis from the big names you know and love. Plus, you never know who may stop by. That's all coming up on the next edition of the Brian Kilmeade Show.
Weekday mornings from 9 to noon on WLNI. And now, back to Purpose-Driven Finances. Here's Alan Molina with Serwus Capital Management.
Hey, good morning again. Alan Molina, your host, Purpose-Driven Finances and President of Serwus Capital Management. I just so hope you're having a blessed weekend, enjoying life, enjoying your family, because I tell you, that's one thing I'm really trying to focus on is enjoying life. I've enjoyed really helping folks out, blessing my family, friends, but really just trying to enjoy life. So I'm sitting here with my co-host Mary and talking about portfolio management, talking about, I forgot the title of the show. What are we watching? Mm-hmm. And if I didn't have paper, I'd forget it. But the name of the show is What Are We Watching? And realistically, what we're getting into is Mary asked me, so what are the gauges that we watch as a financial advisor, portfolio manager? Because realistically, as a firm, we help clients do two things. One, financial planning, and number two, portfolio management. Now, the thing about financial planning is it gives people hope. A hope of, I want to go from point A to point B, and then eventually point D. And D may be, short from here or long term. But realistically, as a financial advisor, I have found financial planning easy. Now, it's not the 1970s. 1970s, we would have to have a calculator. We'd have to, the time value of money and inflation and rates of return. Now it's to the point to where no financial advisor writes that down on paper and calculates it by hand. If they do, they're probably 110 years old, and they probably, are close to a horse and buggy. Everybody uses software. But beyond that, math is so easy for me, and I've been blessed with that ability, that financial planning just comes easy. And so I have found when I do financial planning, it's really easy. But on the other side of it, I've kind of gone down a rabbit trail, this is about portfolio management. And what do I tell them? And, how I do what I do. Now, the first thing is looking at the right gauges is the first thing I try to do is I try to share less than what people actually ask me. Now, Mary, I know that's a strange answer to that question. But if you say, Alan, tell me how you manage portfolio, how you manage someone's portfolio. Mm-hmm. If I start going into geometry and physics and surface volatility, you're like...
The eyes glaze over. Right.
Mm-hmm, you're like, bro, no. So that's what I mean by I try to share less than what people really want to hear. Because sometimes I've been asked those questions and I just unload the wagon and people are like, bro. And the answer is no. And it confuses them and makes them uncomfortable. But also, professional management is not about watching and reacting to every headline. It's, yes, I know about the headlines, but sometimes I don't. It's about watching the totality of things and knowing what is important and what is just noise. It's been interesting because the big drawdown on Thursday, it's basically over on Friday. The quad 4, my guess, is going to be over. We're going into a recovering quad 3. And then we begin to focus on what matters. That's the key. So I hope that answers the question about the gauges.
It does. And then the next question is, so where do you start?
Well, that's a great question. Here's what I do is I don't start with the individual investments. I don't start with individual portfolios. What I do is the first thing I ask is the economy growing? Is it strengthening or weakening? Because that's key. Then, because if you can analyze and tell me what the economy is doing, I can pretty much tell you what's going to happen on a day-to-day basis, a monthly, a quarterly basis in the stock market. Like we talk about quads, and a lot of people are like, Alan, I have no earthly idea what the quads are. I don't expect you to. I do. I'm responsible to know what the quads are. It's the next thing is inflation. Is it rising or falling? Now, Mary, everybody is surprised when I tell them that inflation is falling and that it's going to be expected that in March of next year, the inflation numbers will probably drop 75 basis points. And I'm expecting this time next year, interest rates to be a whole lot lower than they are. Most people are like, come on, bro, you crazy. I'm not going to talk to you. Right, that's fine. But look at what happened last month. This little recent spike up in oil is going to cause inflation to go up a little bit, but it's still going to drop probably 5 to 10 basis points from where it was. That's not an inflationary rising situation. And then finally, those all relate to interest rates and liquidity. And I'm not going to get into that. That's getting into that question where it's, Alan, that's enough.
What if you're getting mixed signals? Like the economy and the market are telling different stories?
Yes. You and I have not dated for years. I'm not talking about you and I.
I was saying I don't think we ever dated.
Yeah,
but,
we never did.
Yeah.
But I'm saying individually,
right.
Separately. I was hoping for a spit out of the coffee moment by our listeners. What? Yes, I knew Mary when she was, 18. No, it's been a long time since we've dated. And so to go back to those times, I've been hanging out with a lot of college students because we mentor, and I got 3 young men who are in college still. Mm-hmm. And it's interesting to see them date. And what ends up happening is the nervousness. And, does she? Now, the one you're looking at, Mary, he's married. He's been married for 5 weeks now, something like that, 4 weeks.
He's looking, you have piqued his curiosity when you're talking about the dating scene, but
right,
go ahead. Yeah,
right.
Yeah.
And so what ends up happening is you're nervous. Does this smile mean that? Does they're walking this way? Does it the way they're holding their fork? And I mean, it just, these people, when they're dating, I'm like, bro, sister, you are just like, make him a friend before, this is not, we date once and now we're getting married. And so what ends up happening is, looking at the market, you cannot get emotional from everything that's going on. That just because X happens doesn't mean you get emotional and you begin selling, you begin changing everything, you begin freaking out. What ends up happening is you need to have a process to help you achieve the purpose and plan. And did I answer your question? I don't know if I did.
Well, I think what you're saying is you're looking for what the market is doing as opposed to predicting.
Well,
right?
yeah, exactly. What I try to do is I try not to be predictive. Mm-hmm. What I try to do is take I tell clients and new clients and old clients and prospective clients, and my wife has tried to tell me to get this out of my vocabulary because this was a harsh statement with my boys growing up. When I would say, I don't care. That was harsh. It's not that I don't care about you. It's not that I don't care about your life. It's not that I don't care about your money. I don't care that the guy blew up the portfolio up in New York because I have no responsibility. I have no control, and it's just a talking point. Realistically, do I care about the water system up in Minnesota? I think that's where it is. Mm-hmm. The 30 townships. Do I care from a Christian man who loves people? Yes. But from a portfolio standpoint, I don't care because it doesn't affect my clients' portfolios. And so the key is the market healthy or weakening? Is the participation broad? Is it dependent upon a few names, which I've talked to you about that? Which areas are getting stronger? Which ones are getting weaker? Let me tell you about another car analogy, and I think I've mentioned it. What I try to do on a daily basis is I try to go to a NASCAR race. And what I mean by that is I track 350 ETFs every day. I try to find the ETFs that are going a little bit faster and the ones that are going a little bit slower in order to figure out where the best place, hopefully, that my clients will have a better opportunity to grow. And then we get into price volume volatility, which helps measure behavior and not predict headlines.
Why do you start when you're working with somebody with the risk as opposed to how much they can make?
The reason being is everybody wants a really nice water cooler. I mean, how many water coolers are around anymore? Not many. WL&I, James River Media, I've never seen a water cooler. Mm-hmm. I mean, there aren't many. That being said, people, when you go to a dinner, when you go to a luncheon, when you go to church, you like to be able to say, man, I bought SpaceX. I got some in on the IPO. You're not talking about it now, bro. Because if you bought it at 150 and it's now 110, that's not a great day. So what ends up happening is the reason I start with risk is because if you can avoid, when I say you, as a portfolio manager, financial advisor, if I can help clients avoid the big drawdowns, what ends up happening is long term, you don't have to take as much risk. But number two, you actually get much better returns. And I think 2 shows ago, 2 podcasts, 2 radio shows ago, we talked about that in great detail. And so the biggest thing there is if you focus on the risk and adjusting to it, because one thing I've talked to people is risk is relative to people. And let's pretend it's 2007, 8, and 9, Mary, and I'm talking to you about risk. You're telling me, Alan, I don't want any risk in my portfolio. How low was it going to go? And I have friends in Lynchburg, and if I mentioned their name, a lot of people would know them. They got devastated by their financial advisor. And it was bad investments, at a bad time. I mean, they were buying Kodak. I mean, bro, Kodak in the middle of a recession. That's like, what the heck? Buying water in the middle of a flood. I mean, come on, man. But that being said, what ended up happening is if you start with risk, it's not in a recession, people can't stand risk. But when things are going great, they want more risk. And that's why somebody has to have a process to manage risk regardless of what's happening in the market. So I hope that answers the question.
It does. We only have a couple of minutes left.
2 minutes and 20 seconds.
Yes. So how do you want to wrap things up? Because we still have a lot we haven't gotten to.
Yeah. Well, we can continue going. I think we got some questions.
Well, let's talk about we understand the environment. We understand the risks. So then what are you asking about the portfolio itself?
Right. Well, I think that's great. So about the portfolio. So the number one thing that we are talking about what's happened in the economy, what's happened in inflation, price volume volatility, taking all that up. And then we've talked about the strength of various investments and where the quads are and things such as that. Then what I would do with your portfolio is decide what evidence really matters to your long-term growth, even if it's a short-term goal. If you have a goal in 30 days of X, is it smart really to take a lot of risk? And if your portfolio is really geared towards 30 or 40 years, then you can adjust it differently. Number 2 is to have rules that you can use to organize the evidence. What are you actually seeing? What is your financial advisor seeing? And I used to be this guy, Mary. I used to say, let me call New York, let me call St. Louis, let me call Atlanta and get actually what's happening. I don't want to be that guy anymore. I want to be the one that actually knows and has the evidence in order to do that. So in my life, professional money management is not about watching more. It's not about the right things in the right order. What it means is to look at the environment first, market behavior, then risk, then align your portfolio according to what is the expectation of the current market. Don't expect 100% returns if we're in a tough road. And so, folks, this is Alan Looney. We got 20 seconds left. Give me a call. I know that's a lot. And really, I want to show the reason I did this is to show you what I do on a day-to-day basis to help you achieve the purpose and plan for your life. I know some of you want to give me a call. You've been busy. You've been working hard. Give me a call this week, 434-316-0246. I want to help you achieve the purpose and plan for your life and have a blessed day.
This is not a suggestion to buy, sell, or use a platform. Only will a suggestion occur after a meeting to determine goals, risk tolerance, and time horizons. Investments involve risks and no guarantee of future results.